appreciate you joining us today. And again, my name is Mike O'Connor. I'm part of the growth team here at Alfonso, and we're excited to talk you through some tax and diversification strategies for newly public company employees. And I've been in tech and working with startups for over 5 years now, from bootstrapped small teams to Series C and beyond. I'm a big reader, everything from nonfiction to epic fantasy. So feel free to post some book recommendations. Um, and our speaker today is Rupesh. He's the senior financial advisor at Alfonso. He has over 10 years of advisory experience. He's an MBA from Boston College, CFA charter holder, and before Alfonso, he managed about $300 million in a hedge fund focused on portfolio management. These days, he works specifically with tech employees navigating equity compensation, RSUs, ISOs, ESPPs, and the tax complexity that comes with all of that. So without further ado, I'll go ahead and pass it over to Rupesh.
Thanks a lot, Mike. Good morning, good afternoon, everyone. Welcome to our webinar. We are here to talk about what happens after the confetti settles, after the IPO, after the lockup period expires, after the Slack ping that you receives, that your shares are now actually tradable. That moment, which should feel like pure celebration, is actually the beginning of one of the most financially complex periods of your life. Because of the first time, it's not your net worth isn't just a number on a paper. It's actually in your broker, and it's real money. And with that liquidity comes a decision tree that most people are completely unprepared for. So today we're going to cover six strategies, not the basic, but not the basic kind of diversify your portfolio, which you might have heard 100 times, but the actual moves that sophisticated investors and their advisors use to protect their wealth at these kind of liquidity events. So here is what we're going to be covering today. So these are 7 strategies, which each one builds on the last one. We start with the problem, which is, of course, the concentration risk. Then we move into the tools to fix it, which are tax loss harvesting, direct indexing, lot selection, and then the framework of how to actually execute the sell downs. And then finally, 2 bonus weapons, which are charity giving and option exercise timing based on your style. Every single one of these has real dollar numbers attached to it. This isn't a philosophy. These are specific implementable moves that can save you tens of thousands of dollars in real money. So let's go. So the first one is concentration risk. So let's take example of Jamie. Jamie worked at a company for 6 years, accumulated 800K worth of stock options. Then the company went public. And by the time the lockup has expired, Jamie has a net worth most people just dream about. But Jamie also have roughly 80% of his wealth in this one ticker. And what Jamie told their financial advisor, I know this company, I believe in this company, and I'm gonna hold it. There's nothing wrong in the conviction. The problem is when the conviction become actually a financial plan. So here is the thing about the concentration risk that nobody explains clearly. So when you hold 40% plus of your net worth in your employer stock, you're not making an investment decision. You are making more like a bet, a single outcome, which is a correlated. If the stock, let's say, drop by 30%, which absolutely it can, even for great companies, your net worth drops 12 percentage points in a day. Also, if you get, let's say, laid over during the same downturn, which historically happens because when the companies tend to not do good, they tend to, lay off people as well. So now you have lost your income and you have simultaneously lost your savings. So we always tell people not to put all eggs in one basket, but somehow that wisdom evaporates when it's your company. The one you helped build, of course, as it kind of went through the IPO. And the enemy here, the thing I really, really want to name today is what we call is inaction trap. It's a psychological kind of paralysis that comes from two things: emotional attachment of the stock and the fear of the tax bill. So if I sell, I most people think if they sell it, they owe 20 to 30% of the gains in capital taxes, and that's true. But what really they're saying is, I would rather risk losing 100% than give up 20 to 37% to protect the rest. So when you frame it that way, the math then becomes obvious. So let's take a look at real numbers, how it kind of stack up. So this chart shows a simple stress test. What happens to a, let's say, 420,000 worth portfolio if your employer stock goes down by more than 30%, which is again not extreme, and can happen in any bear market move. So if you are 100% in this single stock, your portfolio goes to about 294K during that same period. So you lost 126K in paper wealth. But let's say if you are diversified, even partially, the story is very, very different. At 40% concentration and 60%, let's say diversified, you may, let's say, be losing $50,000 instead based on the market moves, rather than that whole 126K. Your diversified holdings soften the blow. And here is the subtle point. The after-tax cost of diversifying in the first place might have been, let's say, 25 to $30,000 in capital gains based on, your final tax bracket, meaning the taxes you were afraid to pay were actually less than half the loss you absorbed by not paying it. That's the concentration risk math. The tax bill feels painful. We all feel the pain, but the alternative is even more painful. So we got to pick basically the less worst of the two. Okay, so now we have established that there is a need to diversify. But the minute you start selling it, you're going to owe taxes. So let's talk about how to reduce that bill, which is this next strategy called tax loss harvesting. The core idea is elegant. Somewhere in your portfolio or in a kind of new diversified portfolio you are building from this kind of diversification, there will be a position that is temporarily underwater. That may be the ETF which you bought last year and is down 8%, maybe some of your previous company stocks, maybe some tech exposure that had a rough quarter that might be down. So how to best utilize that situation? So you sell the realized loss, you immediately reinvest in something similar, which could be a correlated substitute, so that you maintain the exposure to that particular investment and you are harvesting losses at the same time to offset your capital gains. The IRS actually built this in. You are allowed to offset gains with losses for dollar to dollar up to $3,000 per year against your ordinary income and unlimited against the other capital gains that you may have during that particular year. So one critical rule here you need to remember is the wash sale rule. You cannot buy back this exact same security within that 30-day period when you kind of sold it, or IRS just disallowed the losses for you. The key here is buy the similar security, not the same security. So that way you avoid that particular wash sale rule trap while you keep yourself invested in that particular instrument. So in terms of the financial impact, let's take a look at it, how it looks on the paper. So you have 200K in gains from selling your concentrated stock position, let's say. Without any planning, you are roughly owning $60,000 in federal taxes based on, let's say, 30% tax bracket, including state and federal. That money is out of the door. But let's say if you harvested $40,000 in losses from elsewhere in your portfolio, your taxable income now, from in terms of the capital gains, drops to $160,000, and your tax bill also drops to $48,000 now. So you saved $12,000 just probably by doing nothing and just knowing when to sell and how to sell. And here's the kicker. You still owe the same market exposure as you had before. And you didn't sacrifice your investment position. You just rotated into a slightly different vehicle. That means tax savings, full market and full market participation. That's what we call as tax alpha. So now I want to take it to the next level, to the previous strategy, into something which is way more powerful than tax loss harvesting. It's called tax loss harvesting on steroids. Just kidding. It's called direct indexing, and it is one of the strategies that is used to be available for only people that had more than $5 million in investable assets. Gone are those days. In today's world, you can invest with as low as 100K of investment. So most of us, when we diversify, we buy ETFs like S&P 500s, SPY, tech sectors, QQQ, which are simple, cheap, and easy to kind of understand. Direct indexing flips that. Instead of buying the fund, you are actually buying the individual stocks inside the index. So for, let's say, for S&P 500, it's all 500 stocks rather than the ETF itself directly into your account. So in this case, you are owning Apple, you're owning Microsoft, Amazon, each individual security in each lot. So why does it matter for taxes? Because now you can harvest losses for this individual stock level because the ETF can over the period go up. Let's say for a year it was up 10%, but not all the securities would also be up during that particular period. So you take best advantage of the securities which are down, sell them, find the similar securities, or keep minimal exposure for another month and buy them back once that wash sale period has expired. And here is the bonus. You can tell the system to also exclude your employer stock. So today's world, direct indexing has become so much personalized that you can let them know that, okay, I really don't want to purchase these particular stocks, which I'm already kind of concentrated in, so that they avoid that concentration and they help you build tax alpha with those losses going forward. So in terms of financial impact, let's see how it looks, which is very, very significant. So let's say we have two portfolios, both starting at $500,000, both invested in the same underlying assets. The only difference is that one is a standard ETF portfolio and the other one is a direct indexing portfolio with automated loss harvesting, which generates roughly 3% of tax alpha. So on an average, it's 3 to 5%, but in this case, let's take it a conservative case of around 3%. So after 20 years, how it's going to look like, the ETF portfolio grows to about 1.97 million based on historical market returns. What about the direct indexing portfolio? It is up to $2.9 million. That's almost $1 million of additional wealth created entirely just through tax efficiency. No higher risks, no different market exposure, just smart investing. All right. So let's look at the next strategy. This one is deceptively simple, but in our experience, almost nobody does it correctly by default. So when you sell your shares, your broker has to decide which shares you are going to be selling. You might have bought the shares at $10 3 years ago, or more shares, let's say $40 1 year ago, and received RST grants at different prices at $25, $50. All of those are sitting in your account with different cost bases. Now, by default, unless you tell your broker otherwise, most of them would use this method called FIFO, which is first in, first out. That means they sell your oldest shares first. So your $10 shares will get sold first, which obviously were the biggest winners as well. And those are the ones that gonna trigger the biggest tax bill as well. That is why this is almost never the right answer for someone in your situation. So looking at the all four methods. So here, as I mentioned, FIFO is the worst case scenario most of the times. The second method is LIFO, which is called last in, first out. It's good, but it can be risky as well because those are often short-term gains that might be taxed at a higher ordinary income tax rate. And there could be a volatility for the stock. So there is a possibility that you might have missed some other higher cost basis kind of share prices. So the third one is higher cost first, which is much, much better because here you are selling the shares you paid the most for in terms of cost basis, which would most likely generate the smallest gain. But again, there might be some short-term gain holding stocks, which might trigger short-term capital gain for you here. So the champion here is the specific identification where you pick exactly which lots to sell. With specific ID, you can sell your $60 lots, let's say in this case, which was your cost basis, or even your loss lots that may be generating some negative losses for you. While you keep that $10 lot, which was the one with the lowest cost basis for future purposes, let's say either to donate charity, pass it on for legacy, or save it for low tax year. But I mean, the critical item here is you need to find that specific lot before you sell. Once you do the selling, it's never coming back. So make sure you do it before you sell. So let's take a look at the financial impact of it. So three people, let's say, sells their 500 shares, and the market price of that share is $120. Identical transaction on the surface. One person use FIFO, which means sell their oldest shares at $15 cost basis. Here, the taxable gains comes out to be $52,000, 500. Taxes billed at long-term capital gains, which is around $12,000. So the person two uses highest cost first basis, where he sells his most expensive shares at, let's say, $95 cost basis. In this case, taxable income drops to 12,500, but it's a long-term capital gain. It's a short-term capital gain, so the tax bill is roughly around $3,000 in this case. 5,000, sorry. Third person uses the specific identification strategy where they are mixing the tax lots based on the cost prices as well as whether it's a short term or a long term lot. Result $3,200 in capital gains, which means roughly $1,000 in tax bill. So same strategy, same selling. The difference is roughly $11,500 in taxes. The only thing that was changed was the box they checked on the form when they were selling the stock. Okay. So yeah, now you know you need to diversify, you know how to kind of reduce your taxes using tax loss harvesting. So now it's all about strategizing, how to actually exercise and execute the sell down without destroying your tax situation or staying freeze forever. So answer is structuring it in a 12 to 24-month plan. Uh, the reason we picked up this particular framework is if you have less than 12 months, you generally risk crossing a fiscal year boundaries in a way that stacks your income higher. So you could accidentally push yourself into a very high tax bracket, which would increase your taxable income through NII taxes as well as state and federal taxes. If you choose more than 24 months, then it's just about procrastinating with a plan, which is used as a disguise for taking no action. So the five phases that can be used here as a framework are these. So month 1 to 3, you assess full your cost basis, every lot, every grant, every purchase date, identify your tax loss harvesting opportunities, write down the target allocations, and this is also where you would select specific IDs that you want to select in terms of selling via your broker. So the next 4 to 6 months, you sell the first tranche, which could be, let's say, around 20 to 20% of 25% of your stock position. Obviously, you're gonna owe some taxes from it, which is okay. The goal is to start the clock on diversification and pair these gains with your harvested losses. Month 7 through 12, keep harvesting, keep reinvesting. You're deploying into a diversified portfolio, ideally through direct indexing and doing active harvesting as the market gives you opportunity throughout the year. So now come the next year, which is 13 through 18 months. That's when you sell the second tranche, could be another 30 to 35%. By now, you have full year of tax loss harvesting credits. You're also looking at some other strategies like charitable giving for your most appreciated stock, which we would cover again later. Um, and then lastly, from 19 to 24 months, sell the remainder. Now at this point, you probably would be less than 20% in your concentration. You have a diversified, tax efficient portfolio. You have a rebalancing plan, and you're almost done in terms of diversification. So in terms of the financial impact, so let's see how these numbers stack up. So when we are looking at a 500K concentrated position and comparing three scenarios where we sell everything in year one, in 12 months, and in a 24-month plan, we can see the most efficient one is the 24-month plan. So let's say if you do a lump sum sale in year one, on that 500K, you're most likely going to owe 185K in tax bill. That's going to be one brutal year. If you do through 12-month plan, you are spreading across, let's say, two tax years and pairing it with tax loss harvesting to keep you out on the worst tax bracket. That would most likely reduce your taxable um, bill to 110K. And then lastly, if you strategize through 24-month plan, spread it across three tax brackets, you have almost reduced your taxable income by 60% by being more strategic about your selling. So that's roughly 111K difference, not because of any exotic strategy. It's just perfect timing and distribution. So another powerful strategy that can be used is the charitable giving, and we call it as a hedge because it's literally turns a tax problem into a philanthropic win. The strategy is obviously for the subset of you who already give to a cause you care about, which could be a church, alma mater, food bank, climate, or whatever you believe in. So if giving is already part of your life, this is the strategy that makes your generosity go significantly further. Here is the principle. Most people give the money to the way their parents gave. Write a check, tap a button on the charity's website, use your card. That works, but for anyone in this room, this probably is the wrong way to do. The right way is to donate the appreciated stocks inside that you must have received through your IPO. Here is why, because when you donate your appreciated stocks, the shares, let's say you would have held it over for over the years. The two beautiful things that happen here at the same time are one, you get the tax deduction for the full market value of that particular share at that particular time. Second, you completely avoid paying capital gains on the appreciation you otherwise would have just paid it to IRS. So compare that to selling first, paying capital gains, and then donating the leftover to the cash. So you just paid tax for no reason. The charity gets also less. You also get less deductions, and IRS gets more. Ultimately, only IRS is the winner and nobody else. So the cleanest way to do is by doing it at scale using a donor advisor fund. So you contribute the stock once, take the deductions, grant the money to the charity over the years. You don't have to give it that day, that period. You can give it anytime. You'll still get the deductions. It's just you have more control and you have lower taxes with this particular account. So in terms of financials, how it looks like is, so let's say you had $50,000 of appreciated stock, and that's the kind of target which you put for your charity. Let's say for the cost basis, this was $5,000 worth of cost. So we're looking at $45,000 of capital gain. So the first option is to sell the stock, pay the capital gains, donate after tax cash. So here you have paid more than $10,000 in capital gain taxes first, and then you deduct the cash donations. So in this case, based on the deductions of the amount you have given, the benefit for you is roughly $3,900. So let's go for second option. You donate the shares directly through a donor advisor fund, and then you sell shares. What happened? No capital gain taxes here. The deductions you got is for full $50,000 value, not the after tax value. That means the net benefit here is $29,000 almost. Same charitable outcome, same 50,000 going to a cause you care about, but almost a $25,000 difference in your pocket just by using the right vehicle. So, and you look at the bottom of the screen, this is the same financial impact structure from our previous webinar as well, where we showed that this is $10,700 in long-term capital gains avoided, plus $18,500 in deductions that you would get, which equals to roughly $29,000 of benefit. So let's take a look at the last strategy. This is for anyone who is sitting on unexercised stock options, which could be ISOs or NSOs. Quick overview about these particular stock option types. So ISOs are incentive stock options. These are the ones that you can qualify for long-term capital gain treatment if you obviously play them correctly. But the biggest catch that comes with it is called AMT, or alternate minimum tax. So what happens is when you exercise ISOs, the spread between your strike price, which is allotted to you when the company gave you the shares, and the current fair market value. And that becomes the AMT reference item, which is the tax item. It can create a surprise tax bill for you that has nothing to do with the regular tax code that you are probably used to. So what's the NSOs? These are called non-qualified stock options. These are simpler. The way they work is the spread on the exercise is just the ordinary income, which is taxed at your W-2 tax based marginal tax rate. No AMTs, but no preferential capital gain treatment either. So for ISOs, the strategies are exercise early in the year so that you have time to model and pay AMT before December. And then you can also exercise in lower income years when your AMT exposure would be smaller. And then you can also consider 83B election for early exercise. You pay today often comes back to you as a tax credit in future years. For NSOs, the main layer is timing. Ideally, you should not exercise large NSOs in the same year as you have big vests or big stock sales. That's a big stacking on your ordinary income, which most likely gonna end up putting you in a very, very high tax bracket and ultimately making you pay much higher taxes than you would probably do. In terms of financial impact, the table here shows comparison between two identical ISO scenarios because that's where we're going to focus, where there is same option, same strike price, same fair market value, but in two different contexts. So in the first scenario, you exercise $10,000 ISOs in a year, where you already have, let's say, $350,000 in other income for RSU stock sales, your wages, and other types of income. So your total income plus the $2,000 of ISO spread put you deep into the AMT territory. So that would mean roughly $42,000 in AMT taxes. Scenario two, you exercise the same $10,000, 10,000 units ISOs in a sabbatical year. So in this case, your income, let's say, is much lower. Let's say it's $80,000, which could be from your part-time role or part-time job that you had. So the AMT exemption here, most of it absorbs most of the spread. So additional AMT liability that we are looking is actually zero here in this case. Same options, same company, same strike price. That $42,000 difference is just from choosing which calendar year to kind of exercise these particular options. So putting it all together, let's land the plane before we jump to conclusion. So this, if you want to have the key takeaway from all this session, it's this slide. So you can take a screenshot of it, save it, send it to someone who just went through an IPO. Because everything we covered today comes down to one core idea. Your IPO was the beginning of the work and not the end of it. You now have the real money, and the decision you make in the next 12 to 24 months will determine how much of yours is actually going to be keeping. We covered seven strategies here, started by recognizing that the holdings all of your eggs in one stock, which is your employer stock, is the riskiest thing you can do, even if you believe in the company. So diversify. Then use the tax loss harvesting and direct indexing to turn market volatility into your tax credits that offsets the gain when you eventually sell your stock. When you sell, don't let your broker default to FIFO, which is first in, first out. Elect specific identifications and pick your lots intentionally. Spread the sell down over 24 months instead of one big year, and that way you can cut your tax bill by up to 60% on those sellings. And if you are charitable inclined, donate your most appreciated shares to a donor advisor fund. You avoid capital gains entirely in this case and deduct a full market value in your tax filing. And if you have options on the table like ISOs, time your exercises around when your income is the lowest. So none of these strategies requires being a tax genius. It just requires a plan, a right team, and starting before this urgency hits the ceiling. So that's pretty much it from our end. I would pass on the mic to Mike for any concluding remarks.
Awesome. Appreciate it, Rupesh. Really always amazing what's possible when you have the right team behind you with the right strategies. Um, that's going to be it for today. We'll be sending out the recording in an email, and there will also be a link to schedule with one of our advisors so that you can ask them questions specific to your situation.